Good morning, everyone. It is half an hour before the market's going to open on Tuesday, July 9th. I'm testing out a new microphone, so hopefully you can hear me. Please let me know if it's too quiet or you can't hear me or whatnot. So let's take a look at our markets. Yesterday, we did continue just barely to go up. You can see that the range of yesterday's trading was extremely tight, and we basically went nowhere in terms of the market. But since we did open a tiny bit higher than the previous day close, we did technically make a new all-time high. You can take this as a sign that the market is starting to struggle. It was very low volume, lower volume than we've seen in even the last several days, or basically all last week when we had the holiday. So for us to have even lower volume when we're back from the holiday, that's a little unusual and just a sign that there's just not a lot of participation. When we look at the equal weighted versus the S&P, you can see that it's not performing nearly as well. We're not making those all-time highs. And if we take a closer look at it, we can see that we keep bouncing off of this lower level, but our highs are getting lower. So that's actually forming a little bit of a wedge right here. So this is going to get squeezed and more likely break lower than higher. When we see these types of patterns in the overall market, not necessarily on individual stocks, but on the overall market, these will break downwards about 70% of the time. So it is more likely that, significantly more likely that we're going to go down from here than up. If I look at the S&P 500 or the SPY, looks very different. This looks like it's in a very strong uptrend. So if the RSP breaks down, that means that fewer and fewer stocks are above their MA50, and we're really just only being held up by a few stocks, mainly the FANG stocks, semiconductor stocks, and those will eventually start to follow suit, which means we'll break this trend, and that'll be the pullback to the MA50 that we started talking about yesterday. Possibly, depending on how it looks when we get there, maybe even lower, but right now it's the MA50. And before we get to the MA50, we'd of course break this right here. So break of trend, and then not too much further, that would be the EMA20, and then right here, MA50. You see how that lines up really, really well? It's the EMA20 is matching up perfectly with this sideways trading movement, which will become a support region. But if that doesn't hold, which it probably won't, given the severity of a drop that we might see in RSP, okay, because there's really no support here until over here. And then we would just come down to the next level, which is the MA50. If that doesn't hold, then we do have a little bit of support right here. And then if that doesn't hold, then we have some right here. And by that time, that MA200 will come up and hit this right here. So you see that our moving averages are correlating very, very well with our areas of support. Why are these areas of support? I suppose we'll probably have enough time this morning because nothing too interesting is going on. So let me just remove those last few drawings. Why do these areas of support become important, and why do we revisit them? It's because institutions, they're not like retail traders. They don't just buy one time. So a retail trader probably only has a few $1,000s, maybe $100,000. Even if you have $1 million, if you have $1 million, you're not risking the entire $1 million. You're not putting $1 million into the SPY or a particular stock at one time. You are dividing that up among several positions. and you're probably leaving some reserve for cash as well. In general, we'd like to say that about 0.5% or 1% is a conservative amount to put into one investment vehicle, and then 2 to 2.5% would be really aggressive if we're talking about the $1 million level. So 2.5% of a million, that's $25,000. And $25,000 doesn't buy you a huge amount of S&P. So so if I took 25,000 divided by, just call it 500, we're a little over 500 right now, but that would just be 50 shares. So I'm a little groggy this morning, so let me just confirm and make sure I'm not putting my foot in my mouth. Yeah, it's only 50 shares. So you go in and you buy the S&P, well, that's trading tens of millions of shares every single day, and you only want 50 of them, you just buy them. You buy them. Maybe I like it right here. Maybe I liked it. And I was able to pretty accurately call a bottom or call a bounce right here. I like it right here, and I say, oh, we're getting to dangerous levels in the all-time highs in the markets, so I'm going to sell it right here. Okay, so you'd buy your 50, sell your 50, but an institution isn't doing that because they're not just buying 50 shares. They're buying thousands of shares at the same time. 1,000 would be a small lot. That would be a small round lot. So 1,000, 2,000, 10,000, 20,000, 50,000, those would be lot sizes that an institution would buy. So you can't just buy several thousand all at the same time because you would just spike the markets. And you're trying to if I went and just say I bought 50,000 shares right here, then by the time I got done buying my 50,000 shares, the price would be way up here because everyone else would see me buying and they would jump in at it, and the market maker would be like, "Oh, you want it at 500? Well, what about 550 or 510, 520, 530, 540, 550?" And I was only able to get 2 or 3,000 at 500 before they moved it. Then I get another 5,000 when they move it to 520. Then I get another 5,000 when they move it 530. They're just going to keep on moving it up before I'm done with my 50,000. So I don't do it that way because what would happen the very next day was by the time I'm done buying, it might be at 580. And then the very next day, it's just going to drop way back down to 520, 530. And I've lost a whole bunch of money overnight. So institutions can't be all in or all out all at the same time. So they have buying programs that last several days or several weeks, sometimes a couple of months, a few months, and they will buy on certain pullbacks, certain revisions to the mean, depending on the institution and what their particular rules and their risk parameters are. So that means I would buy a few thousand here, then I buy a few thousand here, then I buy a few thousand here, then I buy a few thousand here. And by the time that we're in, you see where I'm buying on all those pullbacks or all those revisions to the mean. Okay. And what happens is now my average price is, if I bought, just say I bought an even amount every time, 5,000 every time. So now my average after the second buying program, my average is here. After the third program, my average price is here. And after the fourth program, my average price is probably right around there. So guess what happens if this market pulls back all the way? Well, the MA50, I'm okay. I'm still profitable. And I might just say, hey, let's buy again. And if I do that, now my average price goes up to here. And I'm still profitable overall on all my positions. If I don't, if I say, oh, well, let's just see how this one goes, and I stay here, then if the market falls down to this orange line, to my cost, then I'm going to start defending it. So you see that, where I either say I'm going to buy here because I pulled back to a mean again, or I'm going to wait until I have to defend my position and I'm going to buy some more. So where are the two areas that we're really likely to bounce off of? It happens to be at that MA50, or exactly where this area of support is. And the second one at my average cost is exactly right here. You see that? So this is why these areas become really important, because institutions, all they care about is their average cost and where the market is relative to the average cost. Anything that helps them buy more, which even if it increased their average cost, if there's still a significant gap between where the market is and their average cost, and they don't care, they're still making money. But and then of course, if it pulls back to their average cost, then they have to start defending their position. And it's going to be difficult to break beyond that level. So for now, that's why I say we move to the MA50 and then we see what happens in the market. Namely, what we're trying to do is we're trying to see what the market maker, or not the market makers, the institutions are going to do in terms of, are they going to add right here, or are they going to wait and see? And if they wait and see, then they're almost for sure going to defend this position right here. If they are unsuccessful at defending that position, then what that means is the market is really, really, really weak. It's really struggling because the demand to sell is just overwhelming their defense, or they're the ones who are selling, which means they're not bothering to defend it. They're just selling out because they're taking profits. We saw how their average cost was already was down here, and the market is way up here, and they're the ones who started to sell. And so if that was the case, then they wouldn't defend that MA50. They would just keep on selling. And then, so hopefully by the time they're over here, they're already out of their position completely. And then there's no one supporting this level. And then we just fall all the way down to that MA200. For the people who are accumulating since down here, that MA200 is still a really good level. And they go, oh, now we're at the MA200, and my risk parameters, my risk committee, my manager, they say that I can't hold anything below the MA200, so I start selling too. But it's okay because I started buying down here, and I'm still making money. I'm still profitable. Whereas if you're all in and all out, you're a retail trader, you go, oh my God, I bought here and we're already at the MA200. I better sell out of it. And then so everyone's selling at the same time. And that's why a bear market might develop. Okay? But we just don't know what the institutions exactly are going to do. What I do know, though, that this is the first, well, actually, this is the first area where they might start buying again, in which case the market can keep on going up. But this is a little less likely given on how weak the market is starting to look. This one is more likely, and therefore a pullback to the MA50 is a pretty good bet. If the institutions don't defend that level, or they don't buy more at that level, and they're the ones who actually started this selling, then we're looking at this. And then, or sorry, if they don't buy more at this level, then we're looking at this. And if they're the ones who started the selling program, then we're looking at this or this. Well, this may be the same thing. By the time we get down here, that MA200 will probably be up here already. And then we're looking at this, and then we're looking at this. Why? Because the areas of flatness are areas where they have bought before. They created that level before. So their averages of their positions tend to hit these areas as well. Either they're going to buy again, and then their average was below that area, or their average lined up exactly with that area, and they're going to defend that level. So that's why these areas in particular become very, very important. So hopefully that gives you a little bit of insight on how these things work. We don't just randomly say, oh, it's not just because it's a flat area. A flat area is a result of the phenomena of everything that I just explained. So the flat areas make it easy to spot, but it's not always a flat area. Sometimes it's in between level, but they do tend to line up at pivots, flat areas, and sometimes certain moving averages. The moving averages just make it a little bit easier for us to spot really quickly. So the MA50 was the same as this. The MA200 will be the same as this. The EMA20 is the same as this. So they tend to line up, but they don't always. So sometimes people are like, well, it should have bounced off of that moving average, but it was like in between the MA50 and MA20. Well, why? But because I don't know, but because institutions, blah, blah, they try to come up with an explanation. The reason why is because the average cost didn't line up with a moving average. A lot of times they do, but they don't always. But it will always, institution's behavior is always dictated by the average cost, just like your behavior is dictated by your entry point. So you don't have an average cost, you have an entry cost. Your average cost and your entry costs are the exact same. What do you do if I buy here and then the market goes up and it pulls back to the EMA20? What do I do? Well, it would be normal for me if I have more cash to add to my position. Say, oh, if I'm trading this long-term trend as a retail trader, okay, I buy here, and then it bounces off of that EMA20. This trend is still really strong. I still expect the S&P to keep on going. What do? I buy more. If this was my 401k, I would buy more. And then I'd buy more. And then I'd buy more. And I'd buy more. And I go, pull back, take all my profits out of all that buying, because what happened? I know retail traders don't actually think like this, but their behavior, they still behave like this, even if they're not aware of what they're doing. If I buy all these times and my average cost is probably right around this orange line right here, and I see that breaking, then I'm going to take my profits. I'm going to take my profits. And then right here, when I see it going up again, I might start buying again right here. After I see it bounce off the MA90 and revisit it, I might start buying again. And then I buy again here, and I buy again here, if I want to try to catch that whole trend. So this is, the institutions are doing the exact same thing. And that's why those levels become important. So hopefully that gives you good insight on how markets move, because it's all institutions. It's not retail stuff. And this business about, oh, you got to beat the institutions and institutions are trying to eat the retail traders and blah, blah. No, institutions couldn't care less. Well, most institutions couldn't care less about a retail trader. They care about what other institutions are doing. And if there is a programmatic selling right here by institutions, then one of two things will happen. Other institutions will line up and say, ooh, we need to get out of here. So that those guys are selling, we better start selling. And then they get out of here. And that would become a bear market. The other is some institutions start taking profits right here, and the other institution says, well, my average cost is right here. I haven't made enough money yet. Or if I start selling, I'll probably just break even or maybe lose a little bit of money because my average cost isn't high enough or is too high to withstand by the time I get out of my positions. So I might start selling here and selling here, but maybe I need to sell 5 times in my selling program. And just by the second time I sell, we'll already be at my average cost. I'm going to lose on those other 3 lots. So I'm going to defend my position. And now you have an institutional fight. And just whoever's bigger, who has more or firepower, more money, is going to win that fight. And either it goes down or it goes up. So for the most part, the markets are institutions trading against each other, not institutions trading against retail traders. That's silly. The amount of money that the institutions have versus retail traders have, it's just it wouldn't even last a whole round. If this were a boxing match, it wouldn't last the full, I think 3 minutes in a round. It would last like 1 minute and they'd be done. They in less than one trading session, they would completely flood all the retail traders. So it's mostly institutions against institutions or institutions with institutions. So right now, basically, after all of that, what we're looking for is a pullback to here to the EMA 20 or a revision to the mean to the EMA 20, which shouldn't be that significant this time around. And then the first significant level would be that MA 50. And if the MA 50 doesn't hold, then we're looking at yeah, so MA 200. By the time the MA 200 comes up, we would be looking at the MA 200. And we'll take a quick look at our. I took way longer explaining that than I intended to, but hopefully that made a lot of sense to you guys. The S&P 500 futures up about 20 basis points, and then the Nasdaq about 30 basis points, and then the Dow completely flat. This is a little extreme, 0 versus 30 basis points. 10 or 20 or 15 basis points would be more normal. So we're starting to see that gap. A lot of emphasis on that Nasdaq. And we saw yesterday that the sectors, really, it's all about the why didn't that work? In any case, it's all about the tech, and it's only one sector, and the tech can't keep doing that. And if we keep stretching this out, then the markets will crack pretty soon. If we got the QQQ and the QQEW, they're both making all-time highs and they're both looking positive. But the difference between that picture and the picture that we see in the SPY, which looks very much like the QQQ, all-time highs, very, very strong. And then this RSP showing us that, hey, we might break down. That picture is a really stark contrast. Like, we rarely see this. Such a sharp difference in the picture between the RSP, the SPY, and then the QQQ and the QQEW. It's really rare to see this. And so that's a big red flag for me. That's why we're starting to look at hedging, VIX hedging, and preparing for a potential pullback to the MA50. So we'll just keep an eye on that. We did talk about a VIX hedge yesterday. We saved the trade. VIX. I thought we saved the trade. All right, I guess we'll put that in real quick and then we'll call it the day. So long call on a VIX. And we just went at the money in this example. Out to August at the money 555. Yep. Save this. Hedge. Okay. So we want to give it a little bit of time because that VIX won't necessarily spike right away. It might spike this week. It might spike next week, maybe even a week from now or 2 weeks from now. So what we're looking for is a spike up to the 14 to 15 level. That would already be quite profitable. But if we really do pull back to that MA50, what we saw was this. The last time we pulled back to the MA50, we saw 13 all the way up to 20, 21. So if we spike up to 15 or 18 or 20, then that hedge will make several times. So about at least 150%, maybe 200 or 300%. So that gives us a nice little profit that would hedge against any long positions that you have that might lose money if we pull back to that MA50. Okay, that's it for this morning. Hopefully you learned a lot. I will see you in the post-market session.